building permits change. The building permits released by the U.S. Census Bureau at the Department of Commerce shows the number of permits for new construction projects. It implies the movement of corporate investments, U.S. economic development. It tends to cause some volatility to the USD. Normally, the more growing number of permits, the more positive or bullish for the USD. Fed speeches and earnings in focus. Earnings season in focus as stocks target new highs. U.S. futures are pointing to another higher open on Wall Street on Wednesday, as companies prepare to report on the third quarter at a time when indices are hitting fresh record highs on an almost daily basis. Companies started reporting third quarter results last week, and while the number has picked up this week, it will likely dominate more and more over the coming weeks. Coming on the back of impressive second quarter results and in a more positive global economic environment, expectations are quite high for Q3. Even taking into account the detrimental impact of the hurricanes towards the end of the quarter. USD rebound continues on prospect of hawkish new Fed chair. The dollar is trading higher again this morning as the possibility of a more hawkish Federal Reserve chair succeeding Janet Yellen in February raises the prospect of more interest rate hikes next year. Market expectations for interest rates next year are already well below those of the central bank, should Yellen be replaced by someone of a more hawkish nature. The market could find itself well behind the curve. We've seen something of a recovery in the greenback over the last month or so, but even still, it's not a million miles from its lows and has some way to go to pair the substantial losses suffered this year. A break and hold above 94 in the dollar index may signal such a correction, which may be well supported into the end of the year should a more hawkish chair appointment be announced and Congress make progress on healthcare and, more importantly, tax reform. In the meantime, it's over to William Dudley and Robert Kaplan to provide an update on where the central bank stands on interest rates. While the Fed may have signaled an intention to raise interest rates once more this year and 3 times next, a number of policymakers have since expressed concern at the lack of inflation, something that also came across in the minutes from the meeting. Kaplan is among those that has shown a willingness to be patient, and it's unlikely that recent data will have changed his views on this. Oil higher on inventory report, but will EIA back up the numbers? Another highlight on Wednesday will be crude inventory numbers from EIA, which come after API reported a significant drawdown on Tuesday of 7.13 million barrels. Oil has been on another impressive run as of late, supported by higher global demand. a rebalancing of the market, and more recently, supply disruptions in Iraq. A similar drawdown today may provide another boost, but given the moves we've seen since the summer, I do wonder how much higher we can go in the short term. While the primary driver in oil markets will continue to be the supply-demand dynamics and how effective the rebalancing efforts are, it is worth noting that if, as highlighted above, we do see a dollar recovery into the end of the year, this could weigh slightly on commodities as they are priced in dollars. UK jobs data doesn't change interest rate expectations. This week's economic data from the UK was seen as being potentially influential when it comes to upcoming votes on interest rates. But as yet it appears the numbers have done little to affect expectations, with inflation and unemployment coming in line with expectations and wage growth only marginally 0.1% better. It seems traders are still convinced that a rate hike this year will happen, even if policymakers appear less sure. People may be inclined to point to the improvement in wages as a sign of tightness in the labor market, but there is little evidence that this is the case. It's also worth noting that wage growth is coming from a low base, and in real terms, it remains negative. This is one of the conundrums facing policymakers and the reason why comments yesterday from Sir David Ramsden and Silvana Tenreiro weren't those of two policymakers convinced that raising interest rates is the correct move. Even Governor Mark Carney didn't sound confident during his testimony before the Treasury Select Committee. Still, if a majority of the Monetary Policy Committee were in favor of raising rates this year at the last meeting, then the data we've seen so far this week will likely not discourage them. There are still many people that believe it's the wrong decision, and data may still result in the decision being delayed, but markets are still heavily pricing it in. ECB's Hansen says it's time to think of making policy less accommodative. Eurozone's strengthening economy suggests that it may be time to think of modest tightening of monetary policy. European Central Bank policymaker Ardo Hansen said in an interview published Wednesday, "The economy is in much better shape than it was a while ago. In this situation, I think it's better to think of making mild adjustments to policy to have it slightly less accommodative than it was before." Hansen, who is a member of the ECB Governing Council, said in an interview to the Handelsblatt newspaper, the ECB is set to announce its latest policy decision on October 26. The bank's asset purchases of €60 billion a month are set to end in December. Economists widely expect the bank to extend its asset purchases till September 2018, but at a reduced size. Hansen, who heads the Estonian central bank, said nothing has been decided yet, but added that he would personally like to see the bank on a path to trimming the size of asset purchases. The policymaker also suggested adjusting the mix in the asset purchase scheme to include more corporate bonds and less government debt, by RTT staff writer. Gold drops to 7-day lows, around $1,280 level on stronger USD by Harish Mengani after an initial uptick to $1,289 area. Gold came under some renewed selling pressure and has now dropped to fresh multi-day lows. The precious metal extended Monday's sharp reversal move from three-week tops and traded with a bearish bias for the third consecutive session amid persistent U.S. dollar strength. The ongoing upsurge in the U.S. Treasury bond yields underpinned the greenback demand and was seen exerting pressure on the non-yielding, dollar-denominated yellow metal, U.S. dollar firm around 93.30. Data, Fed speak on site adding to this fading safe haven demand on improving investors' risk appetite, as depicted by a strong up move across European equity markets. Also did little to stall the commodities slide to its lowest level since October 9, back closer to 100-day SMA support. Next in focus would be speeches by influential FOMC members, New York Fed President William Dudley and Dallas Fed President Robert Kaplan, which would be looked upon to grab some short-term trading opportunities. Technical levels to watch: immediate support is pegged at 100-day SMA, currently near the $1,276-75 region, which if broken could accelerate the slide towards $1,268-67 horizontal support. On the upside, $1,284-85 zone now seems to act as immediate hurdle, above which a bat of short covering could lift the metal back towards $1,291. Intermediate resistance ahead of the key $1,300 psychological mark. Commodities following different paths on a common upward hill. Scotiabank by Sandeep Kanihama. In view of Rory Johnston, analyst at Scotiabank, an accelerating global economy in a weakening U.S. dollar will provide a broadly supportive backdrop and buttress the ongoing recovery of industrial commodity prices. Key quotes: oil markets are rebalancing along prior expectations, though bearish sentiment will require further realized supply deficits for WTI prices to break above $55 per barrel. Industrial metals rallied together through Q3, but prices have since diverged, and we expect metal-specific fundamentals to drive differentiated price performance through 2019. Global commodities are broadly forecast to gain ground through the forecast horizon, but recovery paths are increasingly heterogeneous, both across sectors and within them. Energy markets are experiencing gradual, range-bound recoveries against volatile metals performance. While metals rallied together in the third quarter, prices are diverging again as individual fundamentals reassert control. These market-specific developments are occurring against a widely supportive backdrop, where an accelerating global economy is bolstering commodities demand and broad U.S. dollar weakness is putting upward pressure on dollar-denominated contracts. Chinese industrial and environmental policy remain the key outlook risks, with the timing of stimulus withdrawal as well as the seriousness of supply-side and environmental efforts likely to keep the market guessing. On balance, we anticipate that most industrial commodities will continue to gain in year-over-year terms through the forecast horizon, though bulk commodities are expected to undergo a needed correction and precious metals prices are forecast to fall back on a higher rate environment.